I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast, and today we have another exciting episode. Now, COVID isn't exciting. There's nothing exciting about COVID. I know everyone's tired of the COVID virus.
Yeah, tired of all the unknowns still.
That's right. Still, a lot of fear is out there. People, right? Consumers out there. Right now, we're going to date this. What is today?
May 7th.
Oh, May 7th.
May
Okay.
7th, yep.
We'll probably send this out on May 12th. But right now, everyone's walking around. I mean, people are wearing masks everywhere right now.
Yeah, I was actually wondering if do I still sound okay? I mean, you can't walk into Costco.
Yeah.
Without actually, they're handing out masks now, but they said next week you have to bring your own.
Bring your own.
So can I just say, on one hand, it seems like things are starting to loosen up a little bit.
Mm-hmm.
Feeling a little bit better. On the other hand, there's still definitely, concern and frustration. And, we're sorry that anyone that is still going through any of those pains and trials and tribulations because of COVID-19. But we wanted to kind of touch base on mortgages as it relates to, where we are with COVID and how it is affecting purchases, refinances, timing, pricing, that stuff.
That's right. Things that everyone should be aware of. I think these are going to be helpful. We're going to basically bring up all these things that should be helpful to you if you're looking to refi or get a home loan. And, Governor Ducey said, according to now, May 15th is when we're going to really have the reopening is really going to begin. The shelter in place should come down off on May 15th.
One of the phases, right? Are we doing it in phases?
It sounds really complicated how many different phases there are, but it sounds like May 15th is the big one, big first move. So we don't know how long these things that we're going to mention will have an effect. They could be for a couple days, weeks, months.
Mm-hmm. Yeah. Okay.
So let's just start off. T, what do you want to say about the basic things to be aware of?
Well, I'd probably say, one of the big things is going to be credit scores. So, we always, toot the horn of those that work on their credit scores and get their credit scores up and have high credit scores. During times like this, it's even more important to have those high credit scores. Just because when investors get leery, what do? They become more picky. And the first thing that they end up not wanting to do or not wanting to invest in are those lower credit score loans.
Okay. So what are banks all afraid of? Why are they ratcheting up the interest rates and these risk adjustments on lower credit score borrowers?
What are lenders in this for?
Yeah. Right now, number one, they want to make sure that payments come in, right?
Yeah.
The CARES Act gives the borrowers a right to have 6 months of forbearance, no payments. What they're afraid of is statistically lower credit score borrowers are going to apply and have late payments. And what will happen is it just destroys the value of the note, the mortgage note.
Right.
And the banks are like, no, thank you. We do not want. And the banks get penalized, right?
Yeah.
And so
can you imagine being in business and all of a sudden having some edict, some law come down that says whatever product you're making can actually get abused. Your product can get damaged in some way, and you may even have to take it back. Not that that's a great analogy, but lenders are giving borrowers money, and even before they lend the money, the lenders know that there's certain rights that the borrowers have to potentially not pay for a certain amount of months. So it's really creating some adjustment from the investors within these loans. So
and so I think that overall, all the things that we're about to talk about, these additional things, are all because of this fear that banks have of missed payments.
Okay, so before we move on to the next one, let me just finish up the credit score. So there's really two items that have kind of changed. One is the cash out. The cash out is kind of a big one. Not all banks are here, but there are a lot of banks moving to this where you need a credit score of over 700 to do a cash out. I think that's significant. I mean, that's really significant. 2 months ago, it was, 620?
Mm-hmm. And I think reading in between the lines, what we basically are seeing that banks are afraid of borrowers taking cash out and then going late.
Yeah, and just not paying. And then on the FHA side, and I think Ed, you'd reminded me just a few minutes ago that FHA still has the 580 credit score out there. And so you may see it in some asterisk form, but really a lot of the banks that we're working with are, having, credit score minimums of 620 to 640.
Yeah. Like we technically have a bank that will offer 580, but it's like ridiculous. It's like 3.5 points just to get the loan. And of course, getting an approval is hard anyway between, 580 and 600 in
Right.
scores. So
Yeah. It's
it's
like, hey,
ridiculously expensive.
we got good news, good news and bad news. We can give you a loan. That's good news, but the bad news, you got to give us your 4 front teeth, So it's like, yeah, there may be a loan out there, but who would ever do that? So I think in general, those lower credit scores, this is tough for them. Okay.
Yes. Yes.
What is next?
I think the debt to income ratios is a good one to talk about. Debt to income. When a bank does your loan, they take the debt, the monthly debt, divide it by your monthly income, and it comes up with a ratio.
Mm-hmm.
Now, I know you guys are probably thinking, whatever. That sounds complicated, but 50% as a ratio that was basically the max.
Mm-hmm.
That was the max debt to income ratio that was allowed before COVID. Right
Mm-hmm.
now, we're seeing a lot of banks ratchet that down and have these what we call overlays and saying we want to make sure that the borrowers don't have over 47%. Some might be at 40%. These basically want to make sure you have lower debt to income.
Yeah, right. That's right.
And that's conventional financing. FHA is the same thing. We're seeing a movement down.
Mm-hmm.
But but in some cases we're seeing some banks move it around. But anyway.
Yeah, but there's been a general restriction on some of the debt to income, and I think, as you said, there are some overlays there. So, we do have some banks that will go to a higher DTI, just more levels of restriction. So, if you meet those restrictions, then we can get up to that higher, 50% range. But if not, we'll be wanting to kind of try and keep you within that at 47. So, just something to think about.
Okay.
Okay, so we talked about credit scores, DTIs, cash outs. I talked a little bit about the credit score for cash outs, but really, if we were just to focus on cash outs for 30 seconds, we talked about the 700 credit score. Also, a big one is a lot of banks are reducing the maximum loan to value from 80 to 70. From
Right.
80, that's a big deal.
So what that means is
that would be reduced to 280.
And so with some banks,
with some banks,
not all banks, but a lot of banks, it just, again, an overall restriction is happening on that.
Yeah. And so not only is that reduced, but they've also added some reserves. Yes, 80%, which is always kind of crazy. $400,000 home value would be 320. So 320,000 would have been the normal cash out based upon an 80% loan to value on a $400,000 house. Today, because of COVID, that would be reduced to 280.
And so with some banks,
with some banks,
not all banks, but a lot of banks, it just, again, an overall restriction is happening on that.
Yeah. And so not only is that reduced, but they've also added some reserves, which is always kind of crazy. It's like, well, my whole purpose of getting a cash out is so I can get reserves.
Yeah.
For whatever reason, they do not consider, those are two separate transactions. So you need reserves in order to be able to pull out reserves.
Yeah. I mean, if your mortgage payment's $2,000 a month and the bank says, okay, we want to make sure you have 6 months reserves, they basically take your mortgage payment and multiply it by 6. Mm-hmm. They want to make sure you have $12,000 parked.
Yeah.
Savings, checking. In some cases, we can use retirement accounts, but anyway.
Yeah.
Increase reserves.
Okay, so that was cash outs. What's that for cash outs?
So self-employed borrowers right now, I mean, it depends on what industry you're in, but let's just talk about self-employed borrowers. You're out there, you're filing your tax returns for 2019, right? Mm-hmm. Like, well, a lot of folks have already filed 2019, but self-employed borrowers, a lot of them wait to the very end. CPAs are busy. They are filing. If your income, let's just say, if you're self-employed, your net income was $100,000 in 2019 and 2018, a lot of banks today are taking that number and giving it a haircut. They're saying 25% haircut.
Whoa.
They're going to say so a lot of banks will say they'll only give you credit for like 75% of that value of the income.
Now they're not doing that to W-2 workers, are they?
No, it's just the self-employed borrowers.
So I wonder what the difference is between self-employed
And it's
borrower.
not and it's not all banks, just
Yeah,
some banks. So
yeah,
don't be surprised if you hear that.
yeah. Got it. Okay. Well, they're definitely treating self-employed borrowers differently than W-2.
Oh yeah,
So.
well, one more thing. Self-employed borrowers right now because of COVID, you have to prove, and then this is I think across all banks that we've heard of, um, that you have to prove that you've been in business, that you have business activity within 10 days of closing. So
Mm,
if we're closing, and let's just say it's May 31st, right? We're going to close on May
mm,
31st. You need to provide the bank with a receipt of business, a contract, some type of activity report,
hmm.
something that shows that your business is doing something.
Right. Yeah. Very, very important. We've had a couple borrowers. We were working with their realtor, and it was great because we had just closed a transaction with them like 6 days prior, so we were able to use that.
Yep.
But you might have to get a little bit not creative, but pulling up invoices, things that let them know that you are still in business. You're still
Yeah.
buying staples and rubber bands and screwdrivers and things like that.
And a lot of banks say that they'll take if your business has on your website, if you have a website, right? If you have a business, hopefully you have a website. If
Hmm.
your website has at least an acknowledgement of your hours on it, and even any COVID language that you're in business during COVID, your COVID
Yeah.
hours are maybe different, but you're still doing business.
Right.
That will also work.
That will work. Okay. Yeah, so we've got borrowers literally in the pipeline right now that are in hospitality, that are in retail, that are in restaurant business, that are in the auto business. Banks are taking these, and it's like I'm trying to figure like who's not affected. It seems like there's so many affected ones. It's a very, very big group, and probably underwriters have the latitude to kind of be a little bit subjective about it and call you, affected industry just because there's so many. But basically, there's going to be extra layers of scrutiny on those potentially affected, industries. Again, like the hospitality. So if you are a bellman, they are going to take extra time to make sure that you are in fact, employed.
I don't
That
think
you're
there's that many bellmen out there anymore, dude.
no, I had a friend that actually he made really good living on it.
I bet.
Yeah, he
I
was. I,
I
I was.
think
I
there's
was
that
like,
many. Maybe in Chicago or New York. I wonder
may-
how many
may-
bellmen there are here. There's a
maybe
couple.
think about. I tell you, there's probably some books that some bellman could write. But yeah, I don't know what you'd do if you were in actually hospitality. I mean,
Yeah, you work for one of the
they're not
Marriott,
working.
Hyatt, Hilton. You work for any of the big hotels.
Hmm. So you'd have obviously the verifications of employment that would potentially become an issue, but also second levels of review. So after your file goes through the standard typical level review, it goes into this is a potentially affected industry borrower. So let's put him through or her through another level of review. So just something to think about.
Hmm.
That adds
Hmm.
doesn't increase cost, but just adds timing.
Hmm.
So you keep that in mind.
We don't
Yeah.
even really know how the banks are going to handle that yet. It's even
Mm.
too early. But
Yeah.
we will wrestle through it.
We just closed a loan with a little cafe owner, and we just to the very very end we fought and closed.
When
On
she
the
did dine out or dine or pick
she
up.
did, yeah. It was office building,
Okay. Yeah.
so
I mean, so
not
she had
not
to
a lot of
prove. She had to really
yes,
work hard to prove
yeah.
that things were good.
We had to prove she was buying pickles and tomatoes and
Oh wow.
yeah.
So okay, restaurants, entertainment, sports. I'm gonna put airlines in there too.
Mm-hmm.
Auto industries.
Exactly.
You had an auto someone who worked for
Yeah.
an auto dealership.
Yeah, it came down to a 24-hour pre-closing verification of employment.
Hmm.
But that seems to be pretty standard with all of our COVID files right now. Is that the
Yeah, in
average?
fact, that was one of the points I think we had written down here is
Mm,
across the board, whether you're in an affected industry or not, we're doing verifications. I mean, all the banks out there we know of are doing within 24 hours of funding, they need a verification of employment. So
yeah.
everyone, one of the things we're going to be asking you for, if your lender is asking, is have a manager's name, a
Yeah.
phone number,
Mhm.
HR phone numbers. Because we may need to really get your help if they're not returning phone calls. we're not going to be able to fund your purchase. Or
we just, we work so intently with our borrowers to make sure that we close on time. This is a perfect example. Just a couple hours ago, we were trying to reach one of the HR departments, and the borrower said the HR manager's in a meeting until 4. So we told the underwriter, call at 4:05. And so the underwriter called at 4:05 and got him, and we were set. So literally,
cool.
it comes to those little tiny things. So okay. So we talked about the long review times. We touched very, very briefly on it. It's just, there's extra levels of review, extra layers of review in addition to that. We talked a little about reserves. I don't think we need to spend a whole lot of time on it, but banks are wanting to make sure that people are not in desperate times. Yes, the home is a place where people can go to tap equity, but what they don't want is for people to go and tap into equity and lose all the equity in their home and end up losing their home. So they're really wanting borrowers to be as strict as possible on themselves and wanting borrowers to frankly have emergency fund besides what's in their home. So I think lastly, we're talking about the verification of employment. We've already kind of touched on. So it is standard. Yep. And so we have that still, but we also have this 24-hour, verification prior to close. So, we're finding that we have at least 2. There could be a case where, a third verification could be made for whatever reason. If there was, some type of, I don't know if an income variable is a good enough reason.
Yeah, I guess in some cases we're only doing that very last one, but we are, in a lot of cases we're doing the verification of employment in the middle of the underwriting. But within 24 hours of funding, that's definitely going to happen. So maybe it's just one sometimes.
And then I think the lender and the title are coming up with a kind of a separate standalone rep and warranty that the buyer or the borrower is actually signing, agreeing him or herself that they are in fact still employed. So even if you have your friend pose as the HR department, or even if you have, someone else, write you a letter saying that you're still employed, it still comes down to you and your signature saying, yes, I am still employed.
Right.
So they're really trying to cover all their bases.
All right, man. I think that wraps it up on the list.
Wrap it up. Okay. Well, we hopefully none of this was over intimidating. Hopefully this isn't a sign of, too many layers. There's always lots of layers to financing, but I think that's why it's important to work with people like us, that we know how to maneuver, and we know the ways to ask for certain things to make sure that we get over that hurdle with as ease as possible.
Yes. All right. So everyone, you have a great week. Get through this COVID. Stay healthy. Stay brave. Courageous.
That's right. Stay hopeful.
Yeah, that's right. And then hopefully everyone gets back to work and, get through this. Okay.
Perfect. Let's call it a day.
All right.
All right, everyone. We'll see you.
Hey guys, thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to tom@azmortgagebrothers.com or yours truly at eddie@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917, and 1618695, Equal Housing Lender.